So with that in mind, I'm gonna actually write some of these down. So yeah, interest, expense. Let me pick a color. So the reason why too is whenever you're dealing with any kind of service revenue or sales revenue, the important part of this is revenue, unless it says deferred or unearned. If it's something revenue, it's the same thing as something expense, where it's just thrown into that revenue blender and put into that category. Does that make sense?
Yes.
Cool. What's the other ones?
Wage expense, supplies expense, and then notes payable.
So wage expense and supplies expense, were those also noted to be a liability?
No, they were noted to be equity.
Yes, so it's the same thing with interest expense. Any kind of expense you're gonna find in equity completely. Same thing with revenue, just anything with those taglines at the end. Expenses are expenses, revenues are revenues, and they will always be labeled as such. The only difference is that under deferred revenue.
Okay, besides that, always think expense, revenue, equity.
Yep.
Okay.
And fun fact too, do expenses increase or decrease revenue? I mean, not revenue, equity. Decrease. So even if your expense is going up, your equity itself will go down. Was there any others besides those expenses? What was the last one?
Note payable.
Note payable. What did it say it was?
Liability.
So it is a liability. Same thing with the rule of expense and revenue. If you ever see a payable, any kind of payable, payables will always be in liabilities.
Because they have yet to pay.
Yep. Basically think of payables as basically us saying, okay, we owe you. It's a payable. We can pay, well, we need to pay it off. And because it's a payable, it will be in liability. This is the same thing with accounts payable, or if you ever have interest payable, or any kind of payable account. Think payable, think liability. Basically, we have to pay someone. Does that help make sense?
Yes.
Cool. Was there any ones out of particularity of the from the questionnaire? All right. So I'm gonna go through some of them and we're gonna put them in here and then we'll move on to the next one. But cash, which one do you find that under?
Assets.
Asset. And if there's any questions on why they're categorized as such, let me know. We will go over that. Accounts receivable. And it makes sense why the receivable is in assets, right?
Because we already received it.
Nope, we haven't received it.
But it's it's
Yeah.
Okay. We're gonna receive it eventually.
We're gonna receive it eventually. It's going to get there. So the reason why so just like the payable, just like the expense and revenue, their accounting is just completely full of keywords that will denote exactly where they go. For assets, it's receivable. Oh my goodness, why are they all so big? For assets, if you ever see a receivable, because later on you'll see something called a note receivable or interest receivable. Again, you see that receivable, always think asset. Payable, liability. Expense,
Equity.
revenue,
Equity.
perfect. And it's just always going to be like that. Now let's go with equipment.
Assets.
Assets. And y'all know why equipment is asset? Yep. Now we're going to go with accounts payable.
Liability.
Liability. And y'all know what common stock is?
Tribute capital.
Perfect.
Actually got one, let's go.
Now, next one is retained earnings,
Equity.
equity. Unearned revenue, liability. Supplies,
Assets.
supplies expense,
Equity.
yep. I'm trying to think of the other tougher ones that might have been through, dividends,
Equity.
equity.
Can a dividend be negative, by the way?
No, so dividends are basically what you give to the stockholders or to what the owner takes out.
Okay.
So if we had a negative dividend, that'd be like, oh, we took it back. Well, technically a negative dividend would have been common stock because it's people putting money into it.
Right.
So common stocks and dividends are basically their key opposites.
Okay.
Let me think. Let me look at some of the ones real quick and think of if there's any other tougher ones out there. That might be good to note. Prepaid rent,
Asset.
asset. You guys know why it's an asset?
Prepaid.
Yep. And land.
Asset.
So I want to take a chance to kind of, because you guys are going to get a whole bunch of different accounts later on. These are the main ones that we're going through. And I think the biggest ones that'll have a difference, but a good way to kind of help categorize if you're taking a test and you blank out on, okay, where are these guys going besides the keywords? The best way to look at the accounting equation itself is you have a circle. In the center of it is what the company is made of. This is basically every asset. This is what defines the company. It's what basically makes a company. What makes a company could be what they hold in their investments, what place they have as prepaid rent, the cash, the accounts receivable, the equipment. That's what makes it. Now these are funded by two different things. The equity, which lifts this up. It's everything that's rather contributed or earned. And the last is liability, which is all the debt that lowers it. That's just a little thing I like to show people. I don't know if it helps, but so far people have said it's helped. Knowing exactly where these go from the very beginning, and if you get these in your head, it's some of the most key crucial information for every section going forward, because there's a lot of people that used to come to me last semester who wouldn't know that accounts receivables are assets. So, and it makes everything much more easier because it's basically plug and play at that point. All right.
Hey guys, sorry to say, but at this point in the video, it was not working with audio. We were able to capture the video thankfully, but the audio here had been going in and out. So we're just going to go through this at double time speed, and we're not going to be able to keep at least the discussion, but I can still go over and talk about everything. To the top left, we have income statement. To the right is balance sheet. Bottom left is statement of retained earnings. I was using shorthand just so we could save on time because writing them out is difficult. So we went over during this part, where did each piece of account go? So This is why we put up kind of the framework. And over to the right is a very crude drawing of a balance sheet where we have our assets, our liabilities, and our equity, and they're all kind of separated into their own little quarters with total liabilities, total equity, and having them add together to equal the right side of the accounting equation. You know, assets equals liabilities plus equity. At this point, we were kind of throwing together, okay, where does each one go? So we know retained earnings ends up over in the balance sheet. We see it over in the statement of retained earnings, but its ending resting place is over in the equity side of the balance sheet. And that's if you were to be asked, hey, where is retained earnings found? You're always going to say the balance sheet. It has its own statement, but that's kind of to reconfigure and figure out, okay, what is our retained earnings at? Land and buildings, they're found on the assets in the balance sheet. You're not going to find them on income statement nor on the statement of retained earnings. Same with cash. Now, when we're talking about revenue, it will be found on the income statement. If you go over and look over a balance sheet, you're never going to find the revenue because it has basically ended up in the income statement, where revenue minus expenses. Same thing with expenses. You're going to find its resting place over in the expenses. Those equal net income, but net income doesn't end with the income statement. No, instead net income goes over to the statement of retained earnings. Our accounts receivable is an asset. Earlier we were discussing how receivables are always going to be an asset, so just remember receivables are always going to be an asset. And right now we're just finishing up the statement of retained earnings, because you always take your beginning retained earnings, you add your net income. This will end up with your ending retained earnings, but not only that, that ending retained earnings will be tossed over into equity. Now, equipment, that goes into assets. I'm sorry this is kind of jumbled. We kind of had gone out of order with all of this, because we also have supplies, and those are also assets. We have liabilities, it's accounts payable. We were kind of talking because I remember someone was asking, okay, why did I put it in that order? Why did I specifically try to squeeze supplies there? That's going to be discussed later on, but we typically put things in order from the most liquid to the least liquid. And later on, with a consolidated balance sheet, you're going to have to separate between current assets and long-term assets. But that's going to be a little later on. And the same thing is going to be with liabilities, where there's current liabilities and long-term liabilities. Equity, on the other hand, does not have a separation of category. So note payable is a liability, along with unearned revenue. And remember, even though revenues always go into the income statement, unearned revenue itself is basically a liability saying, hey, we owe this. And dividends will find their into place in the statement of retained earnings. All that's kind of folded up into retained earnings. Common stock is equity. So same with this piece of information. We weren't really able to save the discussion on it, but we were talking about transactional analysis. We were having difficulty just kind of separating into categories. So instead, I've made this balance sheet so we could start talking and viewing how the specific transaction actually affects the different side of the balance sheet itself. So this is a prop one. We had 2 errors with this, I will say, just going ahead of time. I had 100 short on the left, while we had 100 short on the right, while we had 100 extra on the left. So we really just kind of made this on the spot. But that doesn't still change what happens. The numbers aren't what matter here, it's what these things will affect. So I believe the first example that we kind of went over was if we bought supplies with cash. Now, when you buy supplies with cash, your supplies is affected, and your cash is affected. If you notice, your supplies physically goes up while your cash physically goes down. And we had to make sure that we put revenue on because revenue, if you have accounts receivable, obviously you have revenue. So I just had to fix that up real quick. But that still doesn't change the fact that supplies went up. The next one is if we bought equipment on account. Now you see your accounts payable goes up, your equipment goes up. Now if you notice, whatever happens to the left must happen to the right. That's why liabilities and equity are kind of stacked on top of each other, because at the end of the day, what their total is has to equal to assets. Now, whenever we're moving things around on the asset side, whatever goes up on the assets has to go down on the assets as well. That's why your supplies goes up, your cash goes down. When your equipment goes up, your accounts payable goes up as well. Now, if you notice, if our note payable goes up, we say we bought land off of a note from the bank. Your land goes up, your notes payable goes up. If you were to put this in a transactional analysis, you would note that your assets went up and your liabilities went up. Now, someone in the discussion also wanted to bring up what's the difference between an accounts payable and a note payable. Well, the accounts payable is more like a credit card. Note payable is like if you got borrowed from the bank. Now, we'll say that we did service for someone. Our accounts receivable went up. Our revenue went up. Now, no one paid us in cash, but our accounts receivable still went up. And our revenue still went up. We're still dealing with, all right, something happens to the left, something happens to the right. Assets go up, equity goes up. Now, if we say, okay, they did pay us, we lowered that accounts receivable by $400 because someone paid us in cash. Now we're going to bring up that cash by $400. Now you notice the revenue is not touched. This is equivalent to the revenue recognition principle, where when you do service, you recognize revenue. When you do not do service, or, well, technically, you did the service already and now you're getting cash. You did not do service to get that cash because the service was already done. That's why you don't mess with revenue, because that'd be double dipping. Now, if we're dealing with wage payable, where we got $300, well, we didn't get $300. We owe $300 to our employees. We also have to account for wage expense for $300 as well. And because of this, if you look, technically liabilities went up, our expenses also went up by $300. Now, the reason why that is not an increase to equity is due to the fact that expenses bring down our equity. If you remember the income statement, revenue minus expenses, because there is a minus in front of expenses, they are lowering our retained earnings. Because if you remember before, expenses and revenue and dividends all flow into that retained earnings that is spit back out on the balance sheet. They lower our equity. So just always remember, expenses lower equity. So technically, we are still increasing liabilities and decreasing equity. See, I put parentheses around that to show that it is a negative. Now, this is where I found out my errors, and this is a great learning opportunity for everyone, because obviously this balance sheet was made up on the fly. I did not have this pre-made for me. So we obviously had some errors, and I was able to figure out, all right, we have 18,100 on the left and 18,000 on the right. And this is a great way during a test, doing your homework or checking anything to realize if you have any errors. Especially during your project. When you guys are doing your project, make sure your assets equals your liabilities plus equity. That equation is the heart of accounting and is so incredibly important. Now let's say if we were giving $500, but we had not done the service yet, we put that into unearned revenue. The reason being is that we have not earned that revenue. We have been given cash, and because of that, we are now liable to do a service, but we have not done it yet, meaning we cannot recognize revenue. Instead, we say, all right, unearned revenue, I can't sleep tonight because I have to do a job in the next day. Now, let's say if we paid our employees, not the ones we owe money to, but if we straight up just paid employees and said, all right, we give this batch of employees $300, if you notice, our assets go down, our equity goes down, technically. We're still ignoring that wage payable. It's still there because technically we still owe other people money. But if we paid that off, make that a zero, it shows how our liabilities decreased and our assets decrease, which balances out still. Assets go down, liabilities go down, but we do not touch that wage expense because we've already done the wage expense before. And because of that, we know the expense matching principle, where we match expenses where they are due. Over here, we're just kind of looking at the overview of everything together to show, all right, there's our transactional analysis, and this is why it kind of all fits together. Where when we're doing these up and down arrows on rather the homework or the sheet of paper showing, okay, where do things increase, where do things decrease? Putting them to paper and actually crossing out the numbers kind of helps put that into a bigger perspective. That might seem to make things more clear for people who have been struggling with transactional analysis so far. Alright, it looks like this is where the recording finally just started to keep our voices, so turning it back to the group study, y'all. Have a good one.
Alright, let's go back to transactional analysis then.
So payable is when we're giving, like you
Yes.
said, and then like accounts receivable, we're giving, and it's like.
So basically, accounts payable, we pay. Accounts receivable, we receive.
From the customer.
Yep. So I'm gonna erase some of these transactional stuff so that we have a good blank canvas. Because a whole lot of stuff on this.
Yeah, we may or may not have gone
Hopefully it helped.
Oh, I got that one down at least.
I like
think.
self-writing all that because I'm just trying to understand everything else.
Hey, that's okay. That's why we're going over it.
I'm gonna-
This is why these sessions are here. So. Erase all this down here. So we have this transactional analysis here. I'm gonna erase all of this too. So right here, and I'll make it just a little bigger. So. We'll have these guys side by side for a while, and we'll start going through them to kind of figure out, okay, what's happening. I'm gonna be going through, through some of the random ones we've already been through before, but just because a lot of this stuff is repetitive. So first off, dividend of 100 was paid. What is affecting what?
Equity.
Equity. So yes, it's affecting equity. So we're gonna put dividend down here. We're gonna put dividend over here as well. If you notice, the three accounts that are in the income statement and the statement of retained earnings are kind of sequestered off to the side. They're their own little thing. That's because they affect things differently. Revenues don't really affect equity differently, but expenses and dividends always affect revenue differently. Now dividends go up. Now, what else is happening? What does that mean for equity?
It goes down.
It goes down. Now, what else is happening though? Because that's one side of the transaction. This is just saying, all right, this part of equity, this whole section of equity is being affected. but equity is going down because dividends are going up. So. What else is happening?
Like in the asset,
Yep,
the cash,
cash going up or down?
down, not money.
Yep, and if you notice here, both of these are mirroring each other. Just having this on the side to kind of look at help. If you need to, just to write just a quick little thing on your test, writing this down helps. So we're gonna keep going forward with that. Now, we paid employees wages of 1,000.
So we paid them,
We paid them.
and we have the wage payable is nothing.
Yeah, we don't have a wage
We don't
payable.
know, but we have a wage expense,
Mhm.
so our expense will go up. And so our equity will still go down.
Yep. And what does that mean for assets?
We lost money.
You lost money. All right, we bought equipment with cash. We're just gonna stick to cash for a minute. What's happening?
Bought equipment, so. Our assets go up,
Our assets do go up because we got equipment. What else is happening though?
and it's also going down because we're losing money.
Exactly. You see how we have that kind of symbiotic relationship there? Oh, I don't want a triangle. The triangle won't be on the test.
Oh, thank God, I thought it was for geometry again, what's that, God?
So. Now we're gonna say. We bought land on account. What's that meaning?
We got land on account, no, accounts payable
Accounts payable.
and land, so our assets will go up,
Assets go up.
and so does our accounts payable
And where's our accounts payable?
and liabilities.
Like, does that mean the liabilities are going up or down?
Going up.
Exactly. We owe. We're keeping track of how much we owe. So, now we're saying that we did a job on account. Basically, our customer is gonna pay us back later.
No, no. And they're gonna pass it. So accounts receivable,
Accounts receivable, is that going up or down? Does that mean our assets go up or down?
it is going up.
Perfect. What else is happening?
Our revenue
Our revenues are going up or down?
going up,
What does that mean for equity?
going up.
Perfect. Now let's say we got paid, they gave us the money for that service. So the service has already been done, we just accounted for that service. It's a week later, they paid us.
Okay.
What's happening?
Because, that is fine, so, our assets?
Yeah, assets are going up. What assets going up?
Our cash,
Cash is going up, we just got paid, what else is happening here?
accounts receivable,
Now they're going up or down?
down.
Perfect. They owe us
They
less,
paid us.
yep,
Okay, now I understand. Okay, I'm getting it now.
alright,
I was confused with like I was, when I'm hearing customer and then we pay, and then I'm like, okay, that's like this part and then that's the other one, okay. Okay, I'm fine.
it's okay. Yeah, no, once you get kind of the mindset and we know, okay, exactly where we stand. It's common for people to get confused of, okay, are we the customer buying from this place or not? We're always a company. This is us. This is what we are made of as a company. That's why too, I show off the little asset in a circle and that, because we are that company.
Yeah.
So we're gonna go to, all right. We owe interest on one of our debts.
It's our interest expense,
So what's happening to our interest expense?
it's going up,
What does that mean for our equity?
going down.
All right. Now, what else is happening?
What was the first one? Like,
So we owe interest on a note.
what was this on our notes payable?
Not notes payable.
Notes
Close.
receivable.
Not notes receivable either. Notes receivable, we wouldn't owe interest on a note receivable.
Um,
In fact, people would owe us interest. You're completely on par though with that, it's a liability.
We have to pay that interest,
We have to pay that interest.
so accounts payable.
Close, interest payable.
Oh, okay, so.
That's why I'm like answering it for you, because it's like, yeah, no, accounts payable, interest payable. The reason why we make specific payables is for the pure fact of saying, all right, this is specifically what it's for. Account payable is like a credit card.
Mhm.
Interest payable is sequestering this amount, saying, all right, this is how much we owe in interest. Specific reason why is for, like, it is for taxes. That's for later on. That's for knowing real world application to it.
I don't want to.
So yeah, so our liabilities would go up. Think starting to all make sense?
Yeah,
Any more questions on any of this?
no, I'm gonna do that, I'm gonna do that, I hope Sam lost.
Oh yeah, no, honestly, having everything side by side always helps in my opinion, and especially just because you're a accounting major, get yourself really familiarized with this anyway. Because if you get yourself familiarized with this, like she said, like Mia said, everything goes easy. So, anything else you guys want to go over? Because we still got a good hour left.
Am I allowed to ask a question on the homework yet?
Yeah, go ahead.
Okay, because I'm having trouble balancing this one problem. I have no idea what I'm doing all that for.
All right, let's see what that can hear.
Because I didn't write that first. Okay, I got the top one right. It's just I cannot get that bottom one.
So, you have to figure out how to make it equal. So, everything here has to equal 83,800.
Yeah, because I got 800 for that, right?
So,
That's what I got. That was wrong.
think all good?
Yes, thank you so much,
course.
that helped me a lot.
I'm glad.
I thought I'd just come to these because instead of studying, I just do this instead. It's because I get myself. I'm really bad about it.
Yeah, go ahead. Hopefully, I've been seeing Zoom go up and down, up and down, up and down like wild. Hopefully we'll have like a recording of this. If not, then I might try to like do a small little video on it or something just to make up for it, but like hopefully we'll be able to continuously keep these recorded. All right, so what was the question one more time?
The
So,
company, like,
yes, the company, or the company, all right.
Um,
So whenever you're doing like heading, we'll say this is specifically for the financial statement. So we got our income statement. We have our statement of retained earnings and we have our balance sheet. Now, there's two different ways to head it, and this is why it's so important to head it. For the income statement, and we're doing shorthand for this. And statement of retained earnings. What you want to do is always put the company name. And then you put for the month ending, and then you put the date.
but the
Now,
homework, it was like for the month that ended, and then this says as of the month.
so as of the month is for balance sheet.
Oh no, it's gonna be this nitty gritty on like, oh no, we're.
I don't know if the test, but to memorize it, like I had to memorize.
Oh,
it.
she just, for the test, she just said she doesn't care if you do it like that, cause if you do it like that, that's bonus points. She said she might have bonus points. As long as you show, this is what each thing does, pretty much, you're good. It's just the wording's just for extra like bonus.
Yeah, but as an accounting student,
Yeah.
it's probably good enough. So the reason why, and this is how I memorize, my teacher helped me memorize it. For the month ending means that we're going through this whole stretch of a month. This is basically transacting for this month and looking through all of what happened through the days.
Okay.
All of your revenue, all of your expenses.
Mhm.
Your balance sheet is like a snapshot. It is basically this big red dot glaring at you saying, here I am. And that's why it's as of, because it's as of. So if you memorize that 4V is for income statement and statement of retained earnings,
Days.
as of is for balance sheet,
The whole thing.
whole thing. It's
Okay.
basically, it is a snapshot where our camera is here and we're like,
That's it. It's there. So big picture. Specific.
like, okay, this is what happened during this period.
Yeah. Okay. Yeah, we got that. Oh, the homework, like I understand that part, but like I had to look at the video, like the hint video, to see to understand it.
There you go.
So you, I don't know for.
The formula for balance sheet is basically this, except you wouldn't have your wages, expense, and dividends or revenue. That would all be retained earnings.
So you just have everything else except those three?
Yep. Because remember, if you think about it, the only things you really go through with the income statement and the statement of retained earnings is basically you're updating your retained earnings.
Okay.
And your retained earnings is essentially what you've earned throughout your company. So when you start a company, you don't have any retained earnings. You haven't earned jack. So by the end of the month, we do these formulas so we could figure out, okay, as a company, how much have we retained? How much money have we brought in? How much money have we spent to get that money? And how much have we taken and pocketed?
Okay.
So the reason why lies within the statements. So let me erase this and set this up, and we're just gonna run through these. No worries. Transactional analysis have been the talk today. Those, they're some of they're difficult to understand at the beginning, but once you start getting a hang of them, it becomes a little easier. So we're first gonna kind of look at what I've set up here. Over here, we have somewhat of a balance sheet. Well, not a balance sheet. This is a trial balance. The difference between a trial balance and a balance sheet is the fact we have our revenue, expenses, and dividends here. On a balance sheet, those are all turned into, oh, whoops, backwards. Yes. There we go. These three are all turned into retained earnings. So, and over here, it's kind of that transactional analysis. I kind of separated equity into revenue, expenses, and dividends for the pure factor of the fact that expenses and dividends lower our equity. Now, if you remember the income statement and the statement of retained earnings, the income statement is revenue minus expenses. So the biggest reason why equity is lowered by expenses is because if you think about that, we're taking away. Though we are increasing our expenses, it means we've increased the amount we've taken away.
So every time you change that the expenses of revenue, it
For
switches the
expenses, yes, and dividends, not revenue. Revenue, if your revenue increases, your equity increases. So
only expenses and dividends.
only expenses and dividends. Because if you think about it, expenses are when you take away money, same with dividends. Dividends, if you give it, if an owner takes out a dividend, it means you've taken money out of it. So I'm gonna write down the financial statements real quick so that we can kind of run through them and match them together, because I feel like seeing everything all together, all in one, sometimes helps everything fall into place.
Your name is Monty, right?
Yes, my name is Monty.
Thank you.
Of course.
It's common stock the same as contributor.
Yes.
Okay.
So I'm going to. We're gonna use a different color to make these borders. All right. And I'm using shorthand here. But if it doesn't make sense, write it out. IS income statement. SORE statement of retained earnings. Here, guys. I'm gonna keep writing everything out.
Okay, all right, thank you.
So if you look at here, you notice that in these statements, what decreases your equity are the same thing that have negatives in front of them. And this flows into your statement. So your income statement gets your net income. That flows into your statement of retained earnings, which then creates retained earnings that go to your balance sheet. So like I said, these guys in the end all cross out to make retained earnings. And we're basically, everything here is to update that retained earnings. Now, I'm going to run through some examples and we're going to see, okay, do they affect our assets, liability, equity? If they affect our equity, do they affect revenue, expenses, and dividends?
All right.
So let me pull this guy up. We performed a job for the customer for a fee, but they're gonna pay next month. So what account is that going to affect and how is that going to affect our equations?
It's very complicated.
It's
Okay, because I understand the difference between liabilities, but I'm getting. No.
It's okay. So real quick. Because it's hard to understand this without knowing like the classifications. So I'm gonna make a little thing that kind of helps some people at points. We're gonna put this in. So. Everything. So your balance sheet, especially, or we're gonna go asset equals liabilities plus equity. Each one are big key points to a company. We have in this circle here, assets. This is every piece of the company. If you notice the company, if you were to define the company, you would define it by how much cash it has, how much supplies, and what supplies it uses. Equipment, the account receivable. Have a good one.
You too.
The land. These are all what make the company, because without these, you can't make the company. Now, there are two ways to fund these. You have your equity, which raises up your ability to fund. And if you think about it, it's everything that is contributed or earned. So it's rather the common stock where people have given money to the company and aren't expecting us to pay them back. Or you have retained earnings, which is made up of revenue and expenses, which is everything that we've earned and have retained till the end. And what else funds liability? I mean, what else funds assets is liabilities. Those are heavy. They fund, but they are debts that we have to pay. So that's why it's on top and it brings it down.
That is so useful.
I'm glad. I made this up on the spot when I was learning this, and for some reason it helped me a lot, so I decided to share it with others.
It is.
So, when you think about all of these accounts, knowing where they place and how they work within this whole company really helps. Like we know any payable, anything with a payable here, we know that's always a liability because we have to pay someone. That's the best way I know. Every time I see a payable, we pay someone. And those, even though it helps fund that asset, it's heavy. Now, whenever I get revenue, and whenever I have that money to spend and spend it on some expenses, but still pocket a little, we got that retained earnings, which elevates the business up because we're able to actually fund what we want without having to rely on liabilities in it. And anytime you see revenue or expenses minus, not including unearned revenue is a liability.
So what the case that you gave me, that somebody will pay next month, that is unearned revenue.
Nope. So the reason why it's not unearned is because we did the service.
Okay,
Our conscience is clear. We could wake up next morning knowing that we're gonna get money sometime.
okay.
They have to worry about us, which is why that's a receivable,
I see.
because we're gonna get money later. They owe us. The reason why account receivable is an asset, think of credit card companies. They could sell your debt off, whether you pay it or not, or they could come after you. It's an asset to them because that's what their whole company's made out of. All accounts receivable, all that debt. So that's the best way I remember accounts receivable. But with what the example I was going with, saying, all right, we did service and someone owes us money. We know, okay, our accounts receivable is an asset and it goes up. We're not liable for anything. Like I said, we can sleep in tomorrow and know that we've done our part. The big thing is revenue. Whenever we do a service, we record revenue, whether we get that money or not. The reason why is a revenue recognition principle, which is one of the principles you go over at the beginning, where it states every time you complete a service, you record revenue. So we're gonna say our equity goes up because our revenue goes up. And again, if you notice, there's no negative over here by the revenue. Technically, we could put a plus there. And this is why our equity goes up with our revenue. Now, I'm gonna keep going with that example of unearned revenue though. So that's when someone hands you cash and says, all right, here's $500. You're gonna clean my house, right? And so you say, all right, I'll do that next week. If next week comes and you don't clean their house, do you think they're gonna want their money back? It's a liability. We owe them a service. And that's why the moment we get that money, our assets go up because our cash technically went up. And our liabilities go up because that unearned revenue went up. We haven't earned that revenue yet. Now, when we do that service and say, all right, our conscience is clear, I cleaned your house, have a day, that unearned revenue goes down, making our liabilities go down, and that revenue go up because we earned it. Now, something to look over on the transactional analysis, and this is kind of a cheat code. If you notice, whatever happens to assets, the same thing has to happen over here to rather liabilities or equity. So, no, you're good, that's why I paused. So when our assets went up, equity went up. When our assets went up, liabilities went up. But when our liabilities went down, our equity went down. The best way to look at this is because, all right, I wanna do this over here where I have some more space. So assets equals liabilities plus equity. If we separate that, we know whenever our assets go up, one of these guys have to go up. Whenever assets go down, one of these guys have to go down. Or if we're just looking at our assets and say, all right, if our asset goes up, another asset goes down, we have to make sure everything equals. A good example is if we bought supplies with cash, what accounts are affected?
Like something like
Mm-hmm.
that. I think,
Assets are affected, but what accounts?
oh. The cash account
the cash account. So, does our cash go up or does it go down?
down.
Down, perfect. So we're gonna say, all right, cash went down. What else is happening? So we bought supplies with our cash. If we say we bought supplies with our cash, what do you think else is happening?
No.
No.
No revenue.
No revenue,
It's
assets. So our supplies went up. Basically, we went to the store and bought ourselves some markers. So they went up. I'm gonna erase this here. So if you notice here, when we say our cash went up, went down and our supplies went up, nothing happened here, but everything happened here. Because our assets went up and down. That's because the transaction, every transactional analysis is always trying to balance itself out. Now we're gonna go over, let's say we got some workers. We're gonna pay them next week, but we have to recognize we paid them, we're going to pay them. So what accounts do you think are gonna be affected? Yep, you're right.
What is the difference between accounts payable and accounts payable?
So accounts payable is like a credit card. It's like whenever you go to buy some inventory and you're gonna pay them in like a month. A note payable, think of bank loans. Where they're gonna give you 10 grand and say, all right, you're gonna pay us back in 10 years.
Okay.
Sometimes there are short-term notes. But basically think note payable, think of the bank giving you like a nice hefty check and saying, all right, you're gonna give that back to us with interest. So but in this scenario, it would not be accounts payable, it would be wages payable. And there's some things like that, like interest payable or specific payables where it's connected very closely to another account. So wage expense, wage payable, basically meaning, all right, we owe our employees money. Now with accounts payable, like I said, that's like a credit card. That's like we go to the store and we buy it off the company credit card. We'll touch more on that on chapter 4 and 5. But for this example, it's specifically with wage payable and wages expense. But with that in mind, you're right with liabilities. Are your liabilities going up or down?
I'm sorry, where's the question?
So if we owe our employees money, are our liabilities going up or down? Yep, up. So our liabilities go up because we owe people money. And again, it's like even though there's no cash transaction, it's like we're basically putting a finger to what we owe so that we don't have to pay them at this moment. Now, if we go over to wages expense, is that those are gonna be going up. What's gonna be happening to equity? It will not go up. Our equity would go down. Because remember, expenses, it balances, and also expenses lower your equity.
Oh.
Does that help out?
Yes. Yes.
That's why I like to write it all out here.
Thank you.
It's a messy thought process, but it's
I understand. It's perfect. It is perfect. Thank you.
yeah, of course.
I think that's a good